In this learning objective, we discuss smart beta investing and examine the justification for using this approach as opposed to the approach that theory would suggest, which is the Markowitz portfolio selection model. So we've previously seen that if we apply the theory put forward by Harry Markowitz, we should come up with an optimal risky portfolio by simply looking at the expected returns and the variance-covariance matrix between stocks. In this particular case, when we apply Markowitz portfolio selection, we're looking at expected returns through the CAPM, and we're assuming that all expected returns can be explained by that single factor, which is systematic risk, or beta. However, there's a whole lot of assumptions that underlie the CAPM that maybe could be problematic in terms of the validity of this particular approach. So we've already looked at the fact that while the CAPM is underpinned by assumptions related to mean variance utility, there are a range of other utility functions that might better represent investor preferences. There's also a whole lot of empirical evidence that demonstrates to us that beta alone is not able to explain returns. So if that's the case, there could potentially be scope for investors to earn abnormal returns by looking outside Markowitz portfolio selection and adopting alternative approaches. One potential approach is active investing, and active investing is basically stock picking, where investors look at trying to select those stocks that are going to outperform the market using a range of different tools and forms of analysis. However, evidence suggests that active fund managers, after transaction costs, actually underperform the market, so maybe active investing is not an ideal alternative. So more recently, attention's been focused on a new paradigm in investing that takes the best of both worlds from Markowitz portfolio selection and active investing. Smart beta is the process whereby we extend upon Markowitz portfolio selection in terms of using empirical evidence to come up with improved models of expected returns above and beyond the CAPM, and then feed those into the process of coming up with a superior optimal risky portfolio. So with any smart beta investment strategy, it's important to note it's passive in the sense that it adopts a systematic approach. And by systematic, I mean that there is an algorithm that is put in place that dictates which stocks to buy and which stocks to sell. And that algorithm will be based on some screen that is related to the investment philosophy of the particular investor who is managing the portfolio. However, rather than simply just tracking the market index, a smart beta portfolio is designed to track non-traditional risk factors. And therein lies the value in terms of the portfolio manager. It's about trying to identify which of these factors are going to be relevant. Now, when selecting these factors, an investor needs to look at a number of different factors. First of all, this is really where their investment philosophy comes in. The investor should consider their own views on how markets work and whether or not markets fail and where they may fail, and use that to identify particular smart beta factors that might take advantage of potential failings or mispricings. Equally, there should be a scientific approach to smart beta investing that uses both previous empirical evidence, so academic studies are a key source here, but also the portfolio manager should also undertake their own back testing to test the efficacy of their trading strategies before simply diving into adding some smart beta factor into their models. So there's a range of different factors that have been proposed, and these factors form the basis of a number of different funds that are managed by institutional investors around the world. 5 of the most commonly used smart beta factors are momentum, value, growth, low volatility, and quality. So why is it that there may be some merit in considering this idea of smart beta investing rather than simply just passively holding the market portfolio? Well, there's a whole lot of critics of market indexing. Those critics are, first of all, there's an over-allocation to large cap stocks. We can consider this to be particularly an issue in countries like Australia. In Australia, the 10 largest listed stocks comprise approximately 50% of the total market capitalisation of the Australian equity market. So despite the fact that there's over 2,000 stocks listed on the Australian market, half the market capitalisation is concentrated in just those 10 stocks. Therefore, if you're holding the market portfolio with market cap weightings, 50% of your portfolio is going to just be those 10 stocks. So it could be argued that there's some overexposure to those really big companies. Also important to note that benchmarks themselves can be inherently risky. And while holding the market benchmark is the ideal investment strategy for investors who believe that markets are perfectly efficient, if the investor's philosophy was that there is some inefficiency or some market failing, then the market portfolio will actually serve to overweight overpriced stocks and won't actually be the ideal investment for that particular investor. We can give an example of that on this next slide. Okay, suppose for simplicity that there's only two companies. Suppose that both companies have 10 million shares on issue, and let's assume there was some way that we were actually able to observe the intrinsic value of each of those stocks. So the intrinsic value, or what that stock should actually be worth, is $1 per share. So the intrinsic value of each of these two companies is $10 million. But suppose that markets are less than perfectly efficient. Well, in that particular case, let's say that there is a mispricing. There's a mispricing such that company A, while its intrinsic value is $1 per share, we're going to say its market price is $1.20. Company B, while its intrinsic value should be $1, we're going to say it's underpriced. Its market price is 80 cents per share. Now, in this particular case, if we would market weight our assets, what we would do is we would weight them according to their relative market capitalization. So in this simple example where our market is just two stocks, the total capitalization on the market is 20 million. So in that case, we would have 12 over 20 million, or 60% invested in company A, and we would have 8 over 20 million, or we would have 40% in company B. But what is the key implication of this? The key implication is we're actually overweighting the stock that is overpriced. So we're investing more heavily in the overpriced stock than what we should if we were to apply some measure of fundamental weightings, and we're underweighting the underpriced stock. And this will always be the case when we adopt market cap weightings. So if there is any form of inefficiency in the market, this is where market weightings can really break down. So an important point here is that passive investors are assuming markets are relatively efficient, or assuming that market prices are the best available measure of firm value. There's also some other potential issues with using market indexing. So some people who believe in active investing would say that market indexing does not make best use of portfolio managers' skills, but also the fact that you're not able to benefit from some of the evidence that has been put forward that shows that there are these additional smart beta factors that can explain returns, or the fact that returns can be explained by more than just systematic risk. And if we're able to come up with improved models of expected returns, then we can actually improve our portfolio selection. So what we're looking for in terms of smart beta investing is what we would consider to be the holy grail. So we've got our benchmark performance here, which is the performance an investor would generate if they just held the market portfolio. But the holy grail is to think, well, can we actually perform better? Can we increase our Sharpe ratio? And can we do that by either potentially adding a layer of additional performance through smart beta factors, and that is by measuring our expected returns with these multi-factor models, building on the CAPM, but adding these additional factors into our estimation of expected returns? Or potentially, can we generate pure alpha? This is through active investing and using the ideas of active stock picking to try to increase our overall performance. Now, there's a whole lot of empirical evidence that says that this red box, maybe there's not much benefit there, because the evidence shows that active fund managers actually don't tend to outperform the market. However, there is a whole lot of empirical evidence that shows this second box here does have some merit. So we can use smart beta as a way of improving our performance of our investment portfolio.